Well, as we heard at the top of the program, it looks like a deal may be very close on a carbon tax. It's been a big day for taxes that affect the mining industry, and as we've also heard, Greens leader Bob Brown has released a report that he says justifies reintroducing the original mining super profits tax. Ralph Hillman, the Executive Director of the Australian Coal Association, joined me just a short time ago from our Parliament House studio. Ralph Hillman, thanks for joining us.
Pleasure, Steve.
A report released by the Greens today says that 83% of Australia's mining industry is foreign-owned and that over the next 5 years, they argue, $50 billion of mining company dividends will go overseas. Now, the Greens are arguing that this is a strong argument to bring back the original mining tax so some more of that wealth can be shared around amongst Australians. What do you say to that?
Well, there's already the wealth of the mining industry is shared around by the high levels of taxation and royalties it already pays, by the services it purchases and goods it purchases from Australian suppliers, and of course by the very large workforce it employs. And in the case of the black coal industry in New South Wales and Queensland, that's about 40,000 direct jobs and another 100,000 indirect jobs. So it's already underpinning, along with iron ore, the economic wealth of Australia at the moment.
Mitch Hook from the Minerals Council today blasted the report and described it as xenophobic. Do you agree with that assessment?
My take on the report is that it harks back to the bad policies of the 60s and 70s that Bob Hawke and Paul Keating and subsequent governments did so much to get rid of, interfering in the exchange rate, interfering in capital inflows, subsidising selected sectors of manufacturing. These are policies that held Australia back for decades, and we don't want to go back to them. Successful countries today have open markets and are open to capital inflows, and that's the way we need to be to continue to prosper.
Labor's proposed mineral resource rent tax applies only to iron ore and coal. Now, the Greens want it expanded to include uranium and also gold. If there's going to be a mining tax, would you rather see it broadened out so the burden is shared amongst other mining industries?
The coal industry was at the table with the government and agreed to the MRRT, have worked extensively and consulted with government to make sure that it's going to be implemented in a sensible way, and we're looking forward to the passage of that legislation.
So you wouldn't like to see it broadened out?
No. I mean, we did a good deal for us and a good deal for the country. Let's just get on with it, and let's not again add to the disturbance to business expectations and understanding the sovereign risk issue. Every time you fiddle with something like that, you make investors nervous.
Well, let's move on to another tax that's dominating discussions in your industry, and that's the carbon tax. There have been a lot of claims and counterclaims about how many jobs might be lost, how many mines might close down in coal mining areas in relation to a carbon tax. What's your analysis of that?
Well, the Australian Coal Association, which represents the black coal industry of Queensland and New South Wales, commissioned ACIL Tasman to model the impact of the proposed carbon tax, to the extent we understand it as yet, on individual mines. So we obtained very detailed data from 80 mines representing 85% of production to see what this tax would do to the bottom line and how many mines it would render unprofitable. Now, it determined, ACIL Tasman determined that about 18 mines would be rendered unprofitable, with about 4,700 direct jobs involved, and were therefore at risk of closure. That's our finding.
And what carbon price were you basing that assessment on?
That started with an assumption of $20 a tonne at the beginning, which then ramps up, according to the government's own formula, of 4% real increase per annum to about 2015. And then we modelled what sort of price would emerge if Australia was to meet its minus 5% target. And that gets up to around $50 a tonne by 2020. This is a reasonably widely accepted model at the moment, because we don't actually know exactly how the government's going to do this.
So that 18 mines closing down, that's based on $50 a tonne of carbon?
It's based on a trajectory beginning at $20 in 2012 and rising up to about $50 by 2020. And this is a 10-year exercise.
Tony Abbott's been saying that on $26 a tonne of carbon, that 16 major coal mines will close. Given your figures, is that figure accurate?
That figure, in fact, is based on our modelling that we did in 2009 of the CPRS as it then stood. We've since updated our data, got much improved data, and we've used a slightly different set of price assumptions for coal and also for the price of carbon permits. So they're broadly similar, but that explains the slight difference.
OK, the 18 mines that you've identified, are they high emissions mines, underground mines, gassy mines?
Well, that's the interesting thing, and the report quite clearly makes this point. It's not just gassy mines, or it's not just underground mines. It's mines with a high cost structure vis-a-vis their revenue. And that can be a big open cutout west in Queensland, or it could be a gassy mine in the Hunter, which is selling thermal coal, which is of lower value than metallurgical coal.
Because if it is a gassy mine, hasn't Greg Combet said that those kind of high emissions mines would get industry assistance?
Under the 2009 proposal, the government proposed $1.5 billion for gassy mines over 5 years. Now, what the modelling, I repeat, said is it's not just gassy mines. It goes to cost structure, not gassiness. There can be very, very profitable gassy mines. Okay?
And have you considered assistance in your assumptions in relation to how many mines will be lost?
We did in the 2009 modelling, and what the assistance did, Steve, was push the job losses off for 4 to 5 years while the assistance was being paid, but then, of course, the job losses took place the moment it was withdrawn. I'd like to make one other point, though. This modelling on this occasion not only looked at existing mines, it looked at prospective mines, people's plans for new investment. And it found that between 25 and 37% of the employment that would have been created by new mines won't take place. And, of course, no assistance package will change that fact, that the carbon price will render investment in Australian coal mining less attractive in general, but it won't cut global emissions, of course. Production will simply take place elsewhere.
Have you, in your report, calculated how many jobs will be created in that same time frame under a carbon tax?
We haven't modelled the prospective growth of the coal industry specifically. This looked at a mine-by-mine exercise and a sample of new project proposals. There is an expectation that if China continues to motor on and there's no major interruption to global growth, that there remain growth prospects for Australian coal mining, even with a carbon tax. But these will be substantially reduced. There will still be some mine closures and loss of jobs and disruption.
And how reduced would that be?
I can't specify how. Well, I think it's you're looking at 18 mines closing with about 4,700 jobs. In terms of new projects, we can roughly say between 25 and 37% of those planned won't go ahead. Some new projects will go ahead. We are not saying the Australian coal mining industry will collapse. We are saying there will be substantially less growth, which means a big reduction in income to Australia. I think the modelling talks about $20 billion in export earnings lost just from the mine closures over 10 years. And, of course, fewer high-paying jobs created. Coal mining jobs are normally over $100,000 per employee.
Is there a chance, though, that the 18 mines you've identified as potentially closing down could actually be replaced with even more growth within the coal industry, that production could be replaced?
I think it is likely that overall production will continue to grow. You're looking, though, at a substantial reduction in that growth, and you are looking at perhaps a movement of the mining activity into certain parts of Queensland and perhaps further west into New South Wales.
So when you're saying 4,700 jobs could go, you're saying not jobs that currently exist, but jobs that could have existed in the future?
No, 4,700 jobs that will go currently exist, but new jobs will be created, but not as many as would have been the case without the carbon tax.
What evidence is there that overseas producers of coal could take advantage of any increase in production costs via a carbon tax?
Oh, there's plenty of evidence of that. we have very high global coal prices at the moment, and supply responds to demand. Australia has only 6% of global coal production, and there are plenty of active exporters out there like the United States, South Africa, Indonesia. And to give you an example of how quickly we can lose market share, in about 2003 and 4, when coal prices really ramped up, because of infrastructure constraints in Queensland and New South Wales, we weren't able to get our coal out the door. The Indonesians took 15% of our coal market in Asia.
Okay, that's a few years ago now. But if we look at now, if we talk about Indonesia now, in Xstrata's own annual report last year, they say Indonesia's supply faces dwindling quality and shorter mine lives than Australia. So it seems like that their prospects are dwindling.
Indonesia's prospects are still good. I mean, there's plenty of coal there, and they have low infrastructure costs, but they're not the only supplier. I mean, there are half a dozen or more major players, probably 10 major players. We've listed them in a report we prepared recently on the extent to which other countries are applying a carbon tax in their coal mining sectors, and of course no other country is. But there's plenty of supply out there. And it is being dug now, it is being invested in now. The growth will come in supply. It's an inevitable fact of markets.
If there's plenty of supply out there, why is it that when the Queensland coal mines had to suspend production due to the floods over the last couple of years, that the spot prices for metallurgical coal increased significantly at that time? Doesn't that underlie the dominance of the Australian coal industry and the lack of competition from the other sectors around the world?
Every coal mine in the world, I think it's probably safe to say, is producing at close to full capacity. So when you get something like the Queensland floods, you just can't ramp it up. You just, nowhere in the world can really ramp it up. You have to expand mines or create new mines, and that takes years to do, 5 to 10 years probably, depending on the size of the mine and the nature of the deposit.
Doesn't Australia have this huge comparative advantage, though, compared to those other coal countries, in that we can get our coal from port to port very simply and cheaply, and also we have a better quality of coal? Doesn't that give us an advantage that may actually be able to take in extra production costs like a carbon tax?
We do have very high quality coal, and we have improved our infrastructure, and we do use the latest technologies. But the fact is that high coal prices globally are calling forth new supply, new investments in other countries. And when a coal mining company is making a decision where to invest, will it invest in South Africa, Mozambique, Mongolia, or the United States or Indonesia, it looks at comparative costs because the prices are set globally, right? And as you push Australia up the cost curve with the MRRT, with a carbon tax, at the margin, this is where it all happens, we become less attractive, the investment takes place somewhere else.
But the US Government Energy Information Administration says they expect Australia to dominate expansions in the coal export market to Asia in the coming years, while our next biggest competitor, Indonesia, stalls. It seems like the Americans don't see things changing much.
Well, Indonesia just does thermal coal. That's point number one. But there are investments taking place in other areas, including in the United States, which is traditionally focused largely on its domestic market, now looking at export opportunities because the prices are there to drive them. But we will dominate it. Look, there will be growth in the Australian coal industry, most likely, according to the projections of the Australian Bureau of Agriculture and
you think we'll continue to dominate?
Dominate, I think our domination will slip. There are too many new suppliers like Mongolia, massive reserves coming into the market. We'll still be big, but I think Indonesia's already knocked us off our perch as the top exporter of thermal coal. They did that 3 or 4 years ago. So it just shows how quickly it can happen.
Ralph Hillman, we'll have to leave it there, but thanks very much for talking to us tonight.
That was a pleasure. Thank you.